So if you've been anywhere near the financial news lately, you've seen them, those scary headlines about the crypto winter. But what if that's not the full story? What if there's a completely different narrative playing out? One that's not told in headlines, but in cold, hard, on-chain data. Okay, so on one side you've got the headlines, and they're all screaming crash. But then you look at the data from the blockchain itself, and you see something else entirely. While everyone's panicking, the big players, the so-called whales, are quietly buying up tens of thousands of Bitcoin. I mean, how can both of these things be true at the same time?
Right, so that leads to the obvious question, doesn't it? If the headlines are creating fear, but the data is showing quiet confidence from the biggest players, who actually benefits when you're scared? Let's dig into that.
You know, what we're talking about here has a name: information asymmetry. It's one of the oldest tricks in the book for transferring wealth. Money simply moves from the people who are uninformed to the people who are informed. And we are watching it happen right now, live, as the headlines yell panic and the data just whispers, buy. And look, the scale of this buying, it's just wild. While the news focused on the price drop, you had MicroStrategy adding another 3,000 Bitcoin to its stash, whales grabbing 56,000 coins, almost $500 million flooding into ETFs in one day, and maybe the biggest tell of all, Bitcoin kept leaving exchanges. So you have to ask yourself, why would all the smart money be doing this if a real, devastating winter was on its way? Okay, so this is where things get really interesting. It forces us to ask a much bigger question. We're all busy measuring Bitcoin's crash in US dollars. But what happens if we just flip that around? What if the real story is the dollar's own quiet, hidden crash? See, this isn't some big, flashy crash you see on the news. No, this is a slow, steady bleed. Since 1984, the US dollar has lost over 60% of its actual buying power. It's like a silent thief, just taking a little piece of your savings day after day, year after year. And the reason why, it's this number right here, 22.4 trillion. That's the M2 money supply, and it just hit an all-time high. To give you some perspective, nearly a trillion, with a T, new dollars were just created out of thin air in the last year alone. Someone put it perfectly with this quote: every single new dollar that gets printed just waters down the value of the ones you already have in the bank. It's a really simple idea, but it has massive, massive consequences for your future. Now look, I get it. If you've been in crypto for any length of time, you're probably thinking, but hey, haven't we seen this movie before? We absolutely have seen massive crashes in crypto. No doubt about it. I mean, from the Mt. Gox disaster to the huge ICO bubble bursting, Bitcoin has survived drops of 84%. And yes, they were incredibly painful. But in a weird way, they were also necessary. They were like forest fires that clear out all the dead wood and make space for new, much stronger growth to come through. But here's the million-dollar question, or I guess the billion-dollar question now. Is today's market anything like it was back then? Think about it. Back in 2018, there were no spot ETFs, no giant corporations putting Bitcoin on their balance sheets. The market was tiny. Today, we have multiple ETFs creating constant demand. 94% of all Bitcoin is already out there, and huge institutions are buying up more than is even being mined each day. The game has fundamentally, completely changed. All right, so with all that in mind, let's just push the scary headlines and the narratives to the side for a minute. Let's just look at the raw, verifiable math coming straight off the blockchain. Okay, let's start with this number, 111%. What is that? Well, it's something called the MVRV ratio, and it basically compares Bitcoin's current price to what the average person paid for their coins. Being at 111% puts it in a zone that historically has been a signal of undervaluation. The blockchain is literally telling us that the average holder is underwater right now, and that's a sign of a market bottom, not a market top. And you might be asking, well, where is all this Bitcoin going? We can see it right here. Over 31,000 BTC have been pulled off of exchanges in just the last 4 weeks. Now, you don't move your coins off an exchange if you're about to sell them. You do that when you're settling in to hold them for the long haul. And at the exact same time, you've got this other metric. It's called perpetual funding rates. All you really need to know is that when it recently hit -6%, it meant a ton of traders were betting the price would go down. And historically, when bets get that one-sided, the market tends to do the exact opposite and squeeze those positions, pushing the price up. And that's really the magic of all this, right? You don't have to trust me or anyone else. You can go and verify this data yourself. The blockchain is public. The math is right there for everyone to see. But hold on, because even if you trust the asset, there is a new danger we have to talk about. And it's got nothing to do with price swings. It's about something much more fundamental: how you actually hold it. Look, anytime you don't hold your own keys, you're introducing risk. You're trusting someone else. We've all seen exchanges like FTX just blow up. With ETFs, you're trusting a whole chain of third parties. Stablecoins can and do lose their peg, and the issuers can literally freeze your money. Heck, even governments are now massive, unpredictable holders of seized coins. Which all leads back to the number one most important rule in all of crypto. It's not just a catchy phrase, it's a fundamental truth. If you do not control the private keys, you're just holding an IOU. You don't actually own the Bitcoin. So let's put it all together now. Let's look at the two winters side by side. We are all so worried about an asset that's down 45% from its peak, but we're measuring it with a currency that has permanently lost 60% of its value and is guaranteed by its own design to lose even more. So which winter is the one we should really be worried about?
You know, a lot of people get scared by Bitcoin's volatility because we're all used to the fake stability of government currencies. But that stability is just an illusion, and it's maintained by constant printing and manipulation. Bitcoin's price swings, they're honest. They're just the raw, unfiltered result of a true free market at work. So that's the real question I want to leave you with. What's your definition of risk? Is it an asset that has deep, painful crashes but has always recovered to new highs? Or is it an asset that is designed to slowly bleed its value away forever, with absolutely zero chance of ever recovering? The answer to that question, well, it might just change the way you see everything.